Welcome back to The Long Game. I'm Nathan Carter, and yes, this voice is AI generated, but the thoughts I share with you are designed to be human, clear, and deeply useful. Today's episode is about something that may seem boring at first, but it's the quiet hero of smart investing: cash flow. Not revenue, not profit, not stock price. Cash flow. It sounds technical, but if you really understand it, you'll start seeing businesses like a pro. Let me explain. Imagine two lemonade stands. The first one is fancy. It made $100 in sales today. It has a nice website, lots of buzz. But at the end of the day, the owner actually lost money. Why? They spent more than they earned on ingredients, ads, a fancy sign, and delivery trucks. The cash they collected didn't cover the cash they spent. The second stand? It made just $40 in sales. Quiet, no hype, but they spent only $10. No frills, just lemons, sugar, water, and care. So they walk away with $30 in their pocket. Which one would you rather own? Exactly. And that's the idea behind cash flow. It's the real money, the actual cash that flows in and out of a business. While profit can be moved around with accounting tricks, cash flow is harder to fake. It's like asking, after all the costs, all the bills, and all the real expenses, what's left in the bank? Buffett once said, cash is to a business what oxygen is to the body. You don't think about it every second, but without it, nothing survives. Let's take it further. There are different kinds of cash flow. The most important is called free cash flow. That's the money left after a company pays for its day-to-day operations and maintains its equipment or assets. In simple terms, after running the business and keeping it in good shape, how much money is truly free to reinvest, pay dividends, reduce debt, or sit safely on the balance sheet? Let's go to a real-world example. Apple. In recent years, Apple's net income, its profit, was around $100 billion, but its free cash flow, very close to that, sometimes even higher. That's powerful because it means Apple's profits aren't trapped in receivables or tied up in complicated accounting. They turn into cash, fast. That cash lets Apple buy back shares, pay dividends, build new products, invest in the future. Now compare that to another company, maybe one with high revenue, but thin margins and huge capital costs. Their free cash flow might be close to zero. Which one feels safer? Which one gives you breathing room? This is why great investors don't just look at revenue or earnings per share. They dig deeper. They ask, how much of that profit is real, usable, and free? And here's another reason free cash flow matters. It protects you in tough times. During a recession, or when interest rates rise, or when the economy slows, companies with strong free cash flow survive. They don't need to borrow, they don't need to beg. They can wait out the storm. Think of them like camels. They carry their own water. While others run dry, they keep walking. So, how do you actually use cash flow as an investor? Start by looking at a company's financial statements, specifically the cash flow statement. It's one of the key reports alongside the income statement and balance sheet. There you'll see three sections: operating activities, how much cash the core business is generating; investing activities, money spent on assets, equipment, or acquisitions; and financing activities, raising or paying back money, dividends, or share buybacks. Focus on the operating cash flow minus capital expenditures. That's your free cash flow. Is it positive? Is it growing year after year? Is it consistent or volatile? Patterns matter. A company with rising free cash flow is often building strength quietly. It may not be flashy, but it's gaining flexibility, gaining resilience. Let's take another example. Microsoft, Years ago, Microsoft shifted from selling boxed software to cloud subscriptions. Some investors worried, but the result? Massive, growing, predictable free cash flow. That allowed Microsoft to reinvest in Azure, buy LinkedIn, and even pay a dividend, all while keeping its balance sheet strong. That's the power of cash flow. But wait, here's the twist. Free cash flow isn't always a sign of greatness. In some businesses, it can look strong in the short term because they're not reinvesting. They're cutting corners, avoiding upgrades, not spending on growth. So you have to ask, is this free cash flow sustainable? Look at the history. Look at the strategy. Are they milking the cow or planting seeds? That balance matters. Let's bring this closer to you. As a long-term investor, you can think of your portfolio like a mini business. Every stock you own, you're a share owner. You're not just buying a ticker, you're buying a share of cash flow. So ask yourself, if I owned the entire company, would I feel good about the cash it's generating? Would I sleep well knowing it could pay its bills, fund its future, reward its shareholders? If the answer is yes, that's a business worth holding. Now let's end with a simple analogy. Imagine two people. One has a high-paying job but spends almost everything. Fancy clothes, a big car, flashy vacations. The other earns a bit less but lives below their means, saves, invests, builds freedom. Who's really wealthier? The one with real cash in hand. That's what free cash flow tells you about a company. It's the difference between image and substance, between looking rich and being rich. So next time you look at a stock, don't just ask what it earns. Ask what it keeps. Because in the end, it's not what flows in that matters most. It's what flows through and what flows free. That's the quiet power behind great investments. That's cash flow. And that's the long game. Thanks for listening. I'll see you next time.